Hey, good afternoon, everyone. It's Terry Gardner from CJ Lawrence on Wednesday, March 8th, coming to you from Midtown Manhattan. I want to discuss today a strategy which we employ here at CJ Lawrence, which we call innovation at a reasonable price. Because regardless of where the market is and where the economy is in its cycle, innovation never goes out of favor. So a couple of key points. We're going to talk about the Nifty 50, we're going to talk about the internet bubble, and we're going to talk about today's environment. The point being that investors, particularly growth investors, want to buy innovation and disruption. You want to own companies that represent the future. A good example and a reminder is what ChatGPT did recently for Microsoft and for the entire technology space, and kind of reinvigorating the enthusiasm around innovation. But there have been times in our market history where buying that innovation has been expensive. One period that you can run somewhat as a parallel is during the 60s, during the period known as the Nifty 50, when companies that were innovative but also had very steady streams of revenue and earnings were awarded very high multiples. So you had companies like Avon Products and Procter & Gamble who were kind of consistent growers, putting out new products on a regular basis, trading at 60, 70, even 80 times earnings. And that Nifty 50 bubble burst in the 70s with the onset of inflation, where the inflation rate pushed down and pressured stock multiples. So those multiples came in the ensuing years. Another period of time where innovation generated a lot of enthusiasm and high multiples, high stock prices, was as the internet bubble inflated in the late 90s. When we know how that ended in 2000 into 2001 with a complete deflation of that bubble and an onset of a recession. But at the time, investors had to go way out on the risk curve to buy innovation. They had to pay extremely high multiples, sometimes for companies that weren't even generating any sales and earnings. And that ended in tears as well. So what's different this time, and why do we stay focused on innovation but at a reasonable price? Because a lot of the innovation that we're seeing now is being generated by companies that are very solid in terms of their balance sheet and cash flow generation, and have excellent business models and deep competitive moats, and also trade at a reasonable price. So looking at historically at research and development spending, R&D, which we like to use somewhat as a proxy for a company's appetite for innovation and development. Historically, the top of the R&D spending list was dominated by the auto companies and by pharma companies. Certainly pharma companies, because they were constantly looking to develop new drugs and pharmaceutical products, to rebuild their pipelines. And that's how they competed versus each other, versus peers. Same thing with the auto companies, constantly looking to innovate, had to put a lot into R&D to try to generate the new buzz around a new model of vehicle being rolled out, or more particularly in recent times around fuel efficiency. But what we've seen over the last kind of 8 to 10 years is a shift where technology really dominates the top of the spending list for research and development. So there's a couple of names that are household names, which is really the point of this call, are spending the bulk of R&D spending within the S&P 500. Of note, and I'm not making a recommendation buying it or selling it, but I'm just making mention that Amazon.com spends the highest amount in R&D per year by far of any of the S&P 500 companies. In fact, they are expected to spend about $75 billion this year in 2023 in R&D spending. Just to give you some comparison, that is about 7.5 times what Pfizer spends, which is the largest spender of the pharmaceutical companies. So it makes you wonder what Amazon.com may have brewing in its basement or in its garage. And of course, then the rest of the list is dominated by other household names that you would recognize, including Alphabet, the parent of Google, Meta, parent of Facebook, Microsoft, and Apple. But again, going back to our earlier point about a reasonable price, many of these companies are trading at relatively reasonable multiples. close to a market multiple or slight premium. We're not seeing where there's such a high premium that you're taking excessive risk to own them. So you're getting innovation at a reasonable price. And that's kind of the theme that we're following as the debate takes place in the market as to whether we should be owning large cap or small cap, value versus growth. Our point is innovation at a reasonable price is always in favor. We wrote up this topic for an article that was published about a week or two ago in Benzinga, which is benzinga.com. If you want to check it out, we'll include the link in our email, or you can reach out to me and we'll send you the link. In the meantime, have a great rest of your week. If you got any questions, give me a ring at 212-888-6403 or shoot me an email at tgardner@cjlawrence.com. Take care.